Let's talk about financial commodity markets. These are places where raw materials are bought and sold. Think of things like oil, gold, and wheat. These are the building blocks of our everyday products. These markets aren't your typical grocery store. Instead of buying a loaf of bread, investors buy and sell contracts for these commodities. These contracts represent an agreement to buy or sell a specific amount of a commodity at a future date. It's important to remember that prices in commodity markets constantly change. This is due to supply and demand. When supplies are low and demand is high, prices go up. When supplies are high and demand is low, prices go down. So, how do these markets actually work? Think of it like an auction. Buyers and sellers come together to agree on a price. This happens electronically on exchanges all over the world. These exchanges act as a central hub, ensuring fair and transparent trading. They set rules and regulations to prevent manipulation and ensure market integrity. Prices are determined by the forces of supply and demand. If more people want to buy something than sell it, the price will go up. If more people want to sell than buy, the price will go down. Let's look at some common commodities traded in these markets. We have energy commodities like crude oil and natural gas. These are used to power our cars and heat our homes. Then there are metals like gold and silver. These are considered safe haven assets and are often used in jewelry and electronics. And let's not forget about agricultural commodities like wheat, corn, and soybeans. These are the basic ingredients for many of the foods we eat. There are two main types of participants in commodity markets: hedgers and speculators. Hedgers are like farmers. They use the market to protect themselves against price fluctuations. For example, a farmer might sell a futures contract for his wheat crop to guarantee a certain price, even if the market price drops. Speculators, on the other hand, are in it for the potential profits. They buy and sell contracts based on their predictions of future price movements. They're like the gamblers of the commodity market, willing to take on more risk for the chance of a bigger reward. Section 5. Why invest in commodities? You might be wondering why anyone would want to invest in these markets. Well, there are a few reasons. First, commodities can provide diversification to an investment portfolio. Their prices often move independently of stocks and bonds, which can help reduce overall risk. Second, commodities can act as a hedge against inflation. When the prices of goods and services rise, commodity prices tend to rise as well. Finally, some investors simply see commodities as a potential for high returns. However, it's important to remember that commodity markets can be volatile, and there's always the risk of losing money. Section 6. The price tag on commodities. We've talked about how prices are determined by supply and demand, but other factors come into play. Global events, like political instability or natural disasters, can significantly impact commodity prices. For example, a hurricane in the Gulf of Mexico can disrupt oil production, leading to higher oil prices. Economic conditions also play a role. A strong global economy can lead to increased demand for commodities like oil and copper, driving up their prices. Additionally, technological advancements can impact commodity markets. For instance, the rise of electric vehicles could significantly impact the demand for oil in the future. Section 7. Riding the roller coaster volatility in commodity markets. Commodity markets are known for their price swings. These fluctuations can be influenced by various factors such as unexpected weather patterns, geopolitical events, and changes in global supply and demand. This volatility can create opportunities for traders to profit from price movements. However, it also comes with increased risk. It's essential to carefully consider your risk tolerance and investment goals before venturing into commodity markets. Section 8. The big picture commodity markets and the economy. Financial commodity markets play a crucial role in the global economy. They facilitate the trade of raw materials that are essential for producing goods and services. These markets impact everything from the price of gasoline at the pump to the cost of food on our tables. They also influence the profitability of industries that rely heavily on commodities, such as manufacturing and agriculture. Moreover, these markets provide employment opportunities and contribute to economic growth. They attract investors, traders, and other professionals who support the functioning of these markets. Section 9. In conclusion, why this matters to you. Financial commodity markets might seem complex and distant, but they impact our daily lives in profound ways. Understanding how these markets work can make us more informed consumers and investors. By staying informed about the factors influencing commodity prices, we can make better decisions about our finances and be better prepared for economic changes. So next time you hear about fluctuations in oil prices or a surge in gold prices, remember that these events are not isolated incidents. They are part of a complex and interconnected global system that influences our lives daily. Please like, share, and subscribe to our channel for more informative content on financial markets.